In terms of some of the preferred stocks out of the dozen or so,
Yeah.
what are the ones that really stand out for you?
So Whitehaven is cheap for the reasons I mentioned before around thermal coal. You've had competing energy prices, so oil and gas, they've taken a hit. That does impact demand as well. You've also got just demand for electricity is pretty weak, and we've got the trade war layered on top of that. So not a lot needs to go right for that to improve. And you've got, the largest seaborne exporter is Glencore, and they've got form in terms of rationalising production when times get tough, and times are tough now, and there's a lot of the cost curve is underwater. So you could see action on the supply side could help as well. The other ones that are cheap, Iluka's still somewhat undervalued. It's bounced quite a bit from where it was, say, 3 months ago when I last did this update. There's still a bit of value there. I mean, the Mining Area C iron ore royalty that they're spinning off, they probably couldn't be picking at a much better time than doing it this year with the iron ore price where it's at, and with you know um, bond rates very low. People may perceive this thing as a kind of income generating. You know, it won't exactly be fixed income, that's for sure, but it'll be something like that. Um, so I
Almost
think
a
that's
bond
going to,
proxy.
yeah, it is a bond proxy, I would say, but it isn't exactly like a bond because it's not stable income, and it will fluctuate with the iron ore price and production. And South 32 is the other one I think we've got at 4-star rated at the moment.
Yeah.
Um, yeah, coal exposure has been a bit of a negative for them. And also kind of manganese has been fluctuating around a bit. So it did take a bit of a hit, particularly in coronavirus in terms of expectations. And I think the market's expectations are probably a bit on the pessimistic side. We've seen a recovery in kind of zinc and lead prices, and that matters to the value of South 32. So there's a little bit of value in South 32 at the moment. I, you know, I I like what they're doing with the portfolio. I mean, it was a bit of a mixed bag, the spin off from BHP, everything that BHP didn't want, basically. Um, but they're slowly kind of improving it. I think getting rid of coal, thermal coal in South Africa would be an important step. Those kind of moves help improve the competitive position. So looking forward to more of those.
Fortescue is sort of more than double where we think it's a fair value.
Mm. Yeah, so that's a stock that's not that long ago traded with a one or a two in front of it, and I don't mean $10, I mean one or $2. So there's a lot of leverage and volatility in that stock. It is not in the lowest half of the cost curve; it's in the highest half of the cost curve. So when prices come down, that's the one where there's a lot of leverage in terms of their margins and profitability.
Last but not least was this topic of where can investors find yield, and we keep seeing miners thrown out there as potential yield plays. You've got some pretty strong views on why that shouldn't be the case, don't you?
Yeah, so I think in the long term, what really matters is commodity price and how the company invests. So if the company invests well, that's kind of important. But we know in resources that there's a lot of opportunities to make missteps, particularly when prices are high. But what I'm saying is that capital gain component is likely to be the main driver of the total shareholder return. So while the dividends look really attractive now, they are based on an iron ore price, which I think is fundamentally just very, very attractive, and attractive for new entrants. Attractive for the industry. The industry is making ridiculous amounts of money. You look at the kind of returns that Fortescue, it's not a low cost player, is making. They're making very, very good returns. So I would not expect those to last. I mean, you have to kind of form arguments around, it's a rational oligopoly, but we don't see barriers to entry that would make it a rational oligopoly. So while ever the price stays up, the dividends will be nice, but these companies run a payout ratio, and dividends will fall also when prices fall, and share prices are likely to fall when that happens too. So, and the share price part is going to be the biggest part of the total return, I would expect.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.